brought to you in part by AGF. What are you doing after work?
Back to the phones. We have Scott on the line. He's in Petawawa, Ontario. Go ahead, Scott.
Yeah, hi, David. I've seen you on the show in the past, and I've heard you make the comment there that you follow the flow of money. I was just wondering how you do that, and if you had any recommendations for the average investor, how they could follow the flow of money to different sectors.
Sure.
Thank you.
Okay, so Scott, in the simplest of terms, you make money when investors come in behind you and are willing to pay higher prices. So we're always looking for neighborhoods in the market that are seeing net new inflows of capital. And the way I would define that is if you took a sector that had 50 stocks and you gave every stock a single vote and you track the percentage of securities within that group that are in long-term price advances. In a healthy market, the way a cycle unfolds is the strongest stocks start to rally first, and as time goes by, a higher and higher percentage of those securities participate in a rally till late in advance you get to the point where almost everything's working. And unfortunately, that's when people like to make their investments because it's a broad-based rally.
Yeah.
When the breadth of the advance begins to deteriorate, in other words, when the weaklings start to roll over, often the leading stocks can continue on for some period of time, but if the selling picks up enough, it will impact more and more of the securities. So we run a model that tracks the percentage of securities within a multitude of different universes that are in long-term price appreciation. So, for instance, if you were looking for a place to find this kind of data, one of the very good sites I could recommend on the internet is a site called Dorsey Wright and Associates. DorseyWright.com. Okay. And they have a number of breadth-based models. But we only will invest in sectors that are seeing expansion in breadth. And when we see breadth starts to deteriorate, it doesn't mean they're bad companies, but we know 80% of return in the market comes at the hands of the market itself. Is it constructive?
Right.
And the sectors you're targeting. Mm-hmm. So we track market breadth. When breadth starts to deteriorate, start to take positions off and stop putting new ones on. And same at sector levels and same in specific themes and geographies.
So a retail investor could go to Dorsey Wright, but it should be noted that you, along with a lot of your peers, have very sophisticated technology to do this.
Yes, but having said that, there are good tools out there that can help you track flow of funds. Mm-hmm. And I think it's a useful tool to use along with, really solid fundamental analysis, because you still have to find companies that have strong fundamentals that can support higher prices.
Right. Interesting. Let's talk to Paul. He's in Red Deer, one of our regular callers. Hi there, Paul.
Hi, thanks very much, Mark. David, could I please ask you about Valiant Pharma, please? I bought it a couple of points last year, so I've got an average cost of $45, $46, so I'm in the black now. Mm-hmm. I guess the model of buying smaller companies around the world, tucking them in, what do you think? What's your outlook on the stock over the next year or two? Thanks so much.
So it's interesting, Paul. When you look at the pharmaceutical industry, one of the things that they've all recognized is that they have very strong distribution systems. And so realistically, traditionally pharmaceutical companies saw themselves as selling science, developing new compounds and then going to sell them to the world. They built these large distribution networks and figured out that the more they can push through their distribution networks, the more profitable they can become. Valiant ultimately is following that model. They're building out a series of offerings by making acquisitions of drugs and so on that they can sell through their distribution network. It's run by a very savvy guy who comes from the management consulting industry, who understands how to do this stuff. And it remains to be seen long term whether this is a strategy that will work well. But I think you could argue that virtually all of the major ethical drug companies are going down this path. So I think that it's one that is worthwhile taking a look at. If you look at Valiant relative to what some of the metal stocks we were talking about earlier, Valiant has rallied right back from its lows of like $33 in the fall, right back into the mid-50s, basically right back to the highs, recouped everything it gave up last year, has strong relative price performance, performing better than 90% of the stocks in the market. And frankly, the pharmaceutical group is a sector which we think, despite having been out of favor for 10 years, have better prospect because it's an under-owned industry. So we like the sector. Valiant, I think, has a pretty good shot at continuing to grow. And certainly it has to be monitored, but it's a stock that I would be comfortable owning here.
But you don't at this point?
We do have a small position in this company, but we also have positions for the first time in years in Pfizer and Merck and Abbott, more for the dividend yield, but certainly for the stability of the cash flows.
Just a bit of politics here, David. We're getting news from Bloomberg News here that Mitt Romney has won the Virginia Republican presidential primary. It's Super Tuesday, of course, in the United States. See if we can keep you up to date on that. Here's Raza, who is in Brampton. Go ahead. Hi, Raza.
My question is about Best Buy. Stock has been stuck at this price for the last 5 or 6 months. I understand some of the issues surrounding the company battling the online marketplace right now, but the company seems to be pretty healthy, generating good cash flow. Just like to know what your thoughts are on this. I'd appreciate your outlook.
Right. So electronics merchandising is a very tough business, as lots before Best Buy have found. There's an army of companies that have disappeared along the way.
Circuit City
being one of them. When you take a look at what's going on, their growth rate is maybe very low single digit. They're having negative quarters and positive quarters. They're having a very hard time flowing it through to the bottom line. Their earnings are deteriorating. Again, in disclosure, and we're not short a lot of stocks, but of the 20 or so that we are short, Best Buy is one of them.
Really?
And Corning is another, because there seems to be a glut of flat panel TVs on the market, and the Gorilla Glass is not going so well. So I think it's a tough industry, and the online industry has quickened inventory turns in certain industries, and Best Buy, who have to put them on the floor, is at a disadvantage in that space.
And you just have to look at the stock, which peaked in October of 2006, and it's just been a steady, choppy but steady downtrend since then. So David says thumbs down on Best Buy, and indeed he says he's short that stock. We will come back and take a look at David Burrows' past picks right after this.